What's going on, everyone? This is Brandon Rush. Thank you for joining us for another episode of The Agent Investor. Well, The Agent Investor is a series geared towards professionals who are tied into the multifamily, commercial space, or other investment classes. And today, we are here with Lewis Brown. Lewis Brown is an investor, developer. His company's name is Honeycomb Real Estate Partners. They're based out of Avon, Connecticut. I know Lewis through the team I work with, the Lisa Kazi team. And thank you so much for joining us, Lewis.
Thanks for having me.
Yeah, no, absolutely. So, Lewis, we're going to dive right into it. So, tell us a little bit about yourself, how you're involved in real estate, and whatever else you want to share.
Sure. Born and raised in Connecticut. Went to school in the Midwest and then ended up back in Boston after undergraduate and put my first real estate deal together in Boston. It was a small 4-unit condominium deal. From there, went to law school, practiced law in Boston, did a lot of real estate and construction work as a lawyer, and in 2005 moved back to Connecticut and joined a small boutique real estate company specializing in affordable housing. At the time, probably 3,000 apartments, mostly concentrated in the Northeast and in Ohio, and spent almost 17 years there leading the acquisition and development team, over time growing the portfolio to 10,000 apartments, as far west as Texas, as far south as Virginia. And in 2022, I started Honeycomb Real Estate Partners and am focused largely on affordable and workforce housing, both in and out of Connecticut.
Got it. Nice. Thank you so much. All right, so we're going to dive right in. The first question I have for you is, can you define the term affordable housing? I think many people don't have an understanding of what, I know it probably means many things, but for you specifically, what does affordable housing mean?
So for me, it means a range of things, just like for many others. We work in developments and in properties that are what I would define as deeply affordable, meaning the rents are set at levels so that they can be affordable to people earning 20 to 30% of area median income. So if area median income in a county is, say, $100,000 a year, the rents are set at levels affordable to someone who may be earning $20,000 or $30,000 a year. And that range could go all the way up to 80% of area median income, which would be $80,000 a year. That is the traditional definition of affordable, is between 30% and 80% of area median income. And there's different programs in affordable real estate, both ownership and development, where those income come into play. Section 8, which is a rent subsidy program, being one of them, and the low-income housing tax credit program, which was initiated in 1986 under the Reagan's Tax Reform Act, being the other program. So residents would need to income qualify to live at property that has Section 8 or utilizes the low-income housing tax credit program, or it may have both at the property. And the other way I define affordable, which is getting more and more attention every day, and sometimes referred to as workforce housing, and typically that's defined as where rents are affordable to those earning 80 to usually 120% of area median income. Oftentimes you'll hear the description of workforce housing as being affordable to critical essential workers like police officers, firefighters, teachers, EMS, public safety folks are often kind of put into the category of 80 to 120% of area median income or workforce housing.
Got it. Oh, absolutely. Oh, very good. So, question regarding the rent amounts on the affordable housing units. So, is it the actual rent that is set to these ranges, or is it the tenant what they're paying, or is it a combination of both?
So, good question. First of all, in order to qualify, say, at a tax credit property, a low-income housing tax credit property, the owner would be committing to certain rent levels within the band that I described. So if you have an apartment that is set at, say, 60% of area median income, again, using my example of $100,000 being area median income, the person renting that apartment, and I'm speaking kind of broad brush, there's some more details, but the person who is eligible to live and rent that apartment would have to earn $60,000 or less per year in order to qualify to live in that apartment. So that's number one. The way that their rent, though, to answer the second part of your question, would be calculated would be 30% of their income.
Okay.
So you could do the math, 30% of 60,000, then divide it by 12
Got it.
to get the monthly rent.
Got it. Okay, got it. And you spoke multiple times on the low-income tax credit. Is that a credit given by the government, I would assume, for developers and investors who participate in this system or program?
Yeah, so it's a public-private partnership. Every state is allocated credits based on per capita, so based on their population by the federal government. So sitting here in Connecticut, it's a smaller state, so Connecticut gets a smaller allocation of low-income housing tax credits. Annually, the state CHFA, which is the state agency charged with awarding these tax credits to eligible projects or developments, will award once a year credits to the developments, and then the developer, in this case Honeycomb, would sell those credits to an institutional investor, typically a bank or an insurance company, and the sale of those credits generates equity then that comes into the development. And that equity is used to fund things like the construction or rehabilitation of the property.
Got it.
So different from a traditional real estate deal, and this may be a question that you were going to follow up with, where you have an investor that invests equity and expects kind of a return on investment, cash on cash return, IRR. In low-income housing tax credit developments, the investor, again, is a large institution, typically a bank or an insurance company, that is putting their equity into the deal, and in return, a large part of their benefit is their ability to use those tax credits to offset their own annual tax burden.
Yeah, absolutely.
So the way that it works is if you're selling $1 million worth of credits, a bank would come in and they'll typically buy those credits for something less than $1. So say it's 95 cents on the dollar. So you would have $950,000 that comes into the deal as equity, and the investor would get to use the $1 million of credits to offset their tax, dollar for dollar offset their tax. Now they can use them over a 10-year period. So the equity comes in during the development period, but the investor uses the credits over the 10-year period. So there's what's called a 10-year initial tax credit period that the investor gets to use those credits. So it would be $100,000 a year based on that example that the investor uses those credits.
Got it. Okay. And another question on that. So when these tax credits, I don't know the term, are made available, does it come in the form of like an RFP or something like that where they put it out to the public and you respond?
So in Connecticut, there's two different types of credits. This is getting kind of into the weeds, but there's two different types of credits. There's what's called a 4% credit, which I'll call the as of right credit, where you don't apply. And then there's what's called a 9% credit, which by definition, obviously, there's going to be more credits and more equity, therefore, coming into the deal. Those are competitive. So those are what I refer to as the federal government allocating credits to the states. Those are the 9% credits, and those are competitive. In Connecticut, there is one round a year, and there's certain rules and scoring criteria, objective scoring criteria that CHFA evaluates and makes awards based on. The way that those rules are articulated is through what's called a qualified allocation plan, or shortened to QAP. That's published on CHFA's website. In the last 2 years, there's been a 2-year QAP, and we're just rolling out of the 2-year QAP, and there will be another 2-year QAP by the end of the summer that gets announced. So with that, there's every year in Connecticut, right around mid-January, you make application for those 9% credits. And by the end of April, beginning of May, the awards are announced. In Connecticut, because it's a competitive credit and they're highly sought after, typically they're oversubscribed by close to 3 times. So there's 3 times as many applications as there are credits that can be awarded. So it's very, very competitive.
Good to know. Okay, cool. All right, so we're going to jump on to the next question here. What's the current status or the state of affordable housing in Connecticut? I guess what's the current state of affordable housing? That's the question going on in Connecticut.
So Connecticut really is no different than any other state in the country. The United States, you just have to read the headlines every day, but in what many refer to as an affordable housing crisis, there is not enough affordable housing to come anywhere close to supporting the need or demand for it. And that really has worsened over the last 10 years. The gap in terms of affordability has only grown and become much more significant. I've been receiving calls recently from people who are wondering when certain of our developments are going to be completed because they can't find affordable housing in the greater Hartford area and the greater New Haven area to live in.
Got it. Oh, very interesting. Okay. So another question, I guess that's the trend. The trend is affordable housing is becoming much more of a demand. Kind of off script, how do you feel about technology and advancements? I personally feel jobs will be lost in the future just due to technology advances. Do you see that happening, or is that a thing at all, or people losing jobs? What are you seeing?
Well, I think we're moving into a period where we've had a very strong economy for some, not all, for many years. And, I think we're moving into a period where we're going to see a deceleration. With respect to technology, interestingly, the TV show 60 Minutes on Sunday ran a very, very interesting piece on artificial intelligence. And that was some of what was discussed is artificial intelligence is going to replace many jobs across many different industries. And so I do expect that there will be jobs lost. There will also be jobs created. I don't want to be a kind of doomsday scenario, but I believe that with technology and AI, that there'll probably be more jobs lost in the short term than gained.
Got it. Okay, good. And another question I have is investors who are considering affordable housing, like they're at their beginnings of affordable housing, how do they get involved? Where should they start? What steps should they take to start to learn and grow in this space?
So there's a lot of good resources. HUD's website, Department of Housing and Urban Development, is pretty robust in terms of providing information. There are a couple national accounting firms that specialize in affordable housing. Novogradac, and again, I have no attachment to these, so these are not pitches, but just to answer your question about information, Novogradac is another, and their website is NOVOCO, novoco.com. I don't know if you post up this afterward, Brandon. I'm happy to share this information with you. They have a very robust website that has white papers and information on some of the things that we spoke about today. And the second accounting firm that has a similarly robust website is Resnick, Cohn Resnick. So their website is just resnick.com. So there's resources like that out there for you to get more information. In terms of kind of investment, there are a lot of opportunities to invest, different from what I described in terms of tax credit investment, where those are large institutional. You'll also find in the space a lot of private equity coming into affordable housing, different from market rate. Affordable housing doesn't necessarily have the high highs, but it also is fairly stable, and so you don't experience kind of the low lows when you're moving in and out of real estate cycles. So it is a stable investment. In fact, I believe either the Harvard white paper might have been a joint study with Harvard and Resnick some years ago noted that affordable housing of any real estate asset class has the lowest default rate. So quite stable. Some of that obviously is a result of some affordable housing having government-backed rent subsidy, so that creates a stabilizing effect where some of the rent is offset with government subsidy versus just a resident paying the full rent. But in general, it tends to be stable for the other reason that I described, which is there is such a need in the country for quality, affordable housing that occupancy rent rates tend to be extremely high.
Got it. Absolutely. All right. So another question I have is regarding obstacles when people start to invest in affordable housing. What are some of the major challenges you see and opportunities when people are getting into affordable housing?
So, from a traditional investment standpoint, a lot of affordable housing under the two programs that I described, and there's additional, but just to simplify it, under Section 8 and under the Low Income Housing Tax Credit Program, because they are public private partnerships, they are heavily regulated with significant oversight. And so, what I would recommend, and I'm happy to be a resource and share information at the end, but before you make an investment, one, really know who you're investing with and make sure that they know what they're doing. And two, I think it would be prudent for you to understand what you're investing in, like any other investment. It's no different. But you should always make sure that the sponsor, in this case, because it is heavily regulated and heavily compliance driven with significant oversight, make sure that you know the sponsor that you are investing with. I would say is critical. Not necessarily an obstacle, just a good practice. In terms of opportunities, again, from an investment standpoint, the basic law of economics of supply and demand, unfortunately, but it's the sad reality, we are in a situation where there is not enough supply to satisfy the demand. And so that creates opportunities in terms of from an investment standpoint. The other thing I would say, and it's quite important to Honeycomb and to me personally, is make sure whoever you're investing with is doing the right thing, not just by you, but by the residents, the users of the affordable housing, and the communities where the affordable housing is. That's critically important. So I look at it not just as an investment from a dollar standpoint, it's an investment in people, it's an investment in communities.
Absolutely. And one thing you touched on is regarding knowing about your sponsors. So is it common for there to be, for example, I invest in syndications. Is it common to have syndications that are affordable housing based, if that makes sense?
It is. In both the low-income housing tax credit program, sometimes those properties will be in multi-investor funds.
Okay. Yeah.
Not made up of individuals, though. They're made up of the large institutional investors that I spoke about. So you might have a fund that's made up of, and again, I'm naming Connecticut-based banks, but you might have Webster in a fund with, say, M&T Bank or Key Bank in the same fund. So it might be a multi-investor fund with multiple banks investing in that fund, and the fund is made up of 10 or 15 different affordable housing properties.
Got it.
Separately, looking at it more from a traditional real estate investment lens, you might also have deals that are syndicated using traditional kind of private real estate equity with multiple investors, yes.
Got it. Absolutely. Okay. No, very good, very good. And next question I have is, any current or future projects that you're working on?
Yep, we have some exciting things. We have a development in West Hartford, 44 apartments, adaptive reuse and new construction. We have 64 new affordable apartments, new construction in New Haven, Connecticut. We have a small 40 apartment new development in Chester, Connecticut. And we have a number of both developments ground up as well as acquisitions in our pipeline. And then outside of Connecticut, we have a small senior affordable rehabilitation in southern Albany County. And we're also working on some acquisitions in the state of New York as well.
Got it. All right. You guys got a handful of things going on. And is all of that affordable housing, or is it a mix of affordable housing and other?
All that I just mentioned are 100% affordable.
Oh, okay. Good, good.
And, affordable to people earning 80% of area median income and below. The West Hartford, New Haven, and Chester will be developed under the low-income housing tax credit program that I mentioned.
Got it. Great, great. And just to jump back for a sec, so not to get too deep into the weeds, but affordable housing versus workforce housing, is it very similar, like from a high level? I know it's different in terms of the 80 to, I think you said 120% is generally workforce housing.
Correct. The way that I defined workforce, which is the 80 to 120, you would not be able to avail yourself of the low-income housing tax credit program for that income range because the residents would be over income and therefore not qualify for the program.
And
You could do a workforce housing, as you know, just using a traditional real estate equity syndication is often the way that capital stack works.
Got it. And the last question before we start to wrap up, the actual buildings themselves, so ground up development, is it different in the way you develop, say, a affordable housing building versus a market rent building in terms of, or is it really, there's really no difference in terms of the build or the way it's set up or anything else?
I would say that if you took a tour of our West Hartford, New Haven, or Chester developments after they're complete, you would not be able to distinguish our development from what you're calling market rate. The idea being that regardless of your income, you should be able to live in a high quality residence just like anyone else. I think that the low income housing tax credit that was born out of the 1986 Act was transformational in terms of the way that both public and private entities thought about affordable housing development.
Got it. Oh, very good. Okay. No, perfect. All right. So we're going to start to wrap up. We're getting out of the real estate related questions and kind of a little bit more personal. So when you're not working in your affordable housing developments and with Honeycomb, what are some of your hobbies? What do you enjoy doing offline?
So I love family. I love sports. I am and have been for a long time. I fancy myself a guru of meditation and mindfulness, and so spend a lot of time thinking about mindfulness and am hoping to soon go on a mindfulness retreat. I like to read about and think about all the crazy ways that our brain works and trying to tap into different areas of our brain that maybe aren't so present in our everyday. So those are some of the things I like to do, and I enjoy reading and traveling.
Nice. That would explain your Zen. Have you ever read the book The Untethered Soul or heard of it?
I have not.
Okay. So
now I will.
It's a mindful, just zenny, calming book that I've read. A coach once recommended to me when I was going a little crazy in my life. It's definitely an amazing book. But anywho, on to the next. How can people find you, get a hold of you, contact you, whatever way, what channels?
Sure. My email is lbrown@honeycombre.com. L Brown like the color at honeycombre.com. And I wouldn't call it a website. We have what's called a landing page, which is honeycombre.com. And you can read a little bit more about us and the work that we've done. And soon we'll be putting some more content up there as the developments that I mentioned today are mature a little bit further and matriculate through the development period. So we've got a lot of stuff going on, a lot of exciting stuff, and really appreciate the opportunity to talk a little bit about those things today.
Absolutely not. I appreciate you coming on. And the last question, do you have any final words for the audience or anything I'm going to throw out before we take off?
Sure. Kind of a thankless ask, but I think an important one, and plan to do this at our Thursday discussion as well. Oftentimes, I think people have some misperception of, and I'm glad that we're having this conversation and that you asked the question on kind of the difference between affordable and market rate, a misperception of affordable housing. And I would just ask that, if there is a developer looking to do affordable housing, build affordable housing, or renovate affordable housing in your community, that you certainly ask questions and get the information. But I think it's important to keep an open mind and recognize that communities are only better and stronger with different types of people living there, and different types meaning all income levels, all races, ethnicities, etc. And keep an open mind. And oftentimes I think you ask what some of the biggest kind of obstacles are, and oftentimes the obstacle is misinformation, and that can be a real impediment. But affordable housing is good for all communities, and so I would ask that people at least give that some thought. That would be my parting thought.
I know. Appreciate it. Very good. Very good. All right, Lewis. Well, first off, thank you so much for joining us today. Another episode of The Agent Investor. And to our audience, thank you all for joining us once again for an episode of The Agent Investor. We'd like to wish you all the best in your health and happiness. And until next time, thank you all so much. Thank you, Lewis. And we'll see you later.
Thanks, Brandon.